I was at a dinner party last Saturday night. It was one of those evenings that feels perfectly curated to make you believe that civilization is peaking. We were at a steakhouse downtown, the kind of place with dark mahogany walls, tufted leather booths, and acoustics designed to make every conversation sound intelligent. The wine was breathing in a crystal decanter. The appetizers were intricate little sculptures of tuna and avocado. The lighting was low and expensive. Looking around the table, you would have to conclude that everything was going great. Everyone there was a winner on paper. To my left was a corporate lawyer. To my right, a software architect. Across from me was a couple who had just renovated their kitchen. We were the demographic that the news talks about when they say the economy is strong. We were the people with the 401k, the home equity, and the steady paychecks. Inevitably, after the second glass of Cabernet, the conversation drifted to the market. It always does lately. It's become the national pastime, replacing baseball and the weather. A guy across the table, let's call him Steve, pulled out his phone. He wasn't checking a text. He was checking his brokerage app. He refreshed the screen, watched the little green line tick upward, and let out this involuntary, satisfied sigh. The S&P just hit another all-time high, he announced to the table, turning the screen so we could all bask in the glow. My portfolio is up 22% this year. 22%. It's absolutely ripping. The table literally cheered. Glasses clinked. People nodded sagely. Someone made a joke about retiring early. Someone else mentioned that their Zillow estimate had gone up another $50,000 while we were eating appetizers. For a moment, the air in the booth felt electric. It felt like we were all geniuses. We were the chosen ones, riding the wave of the greatest financial engine in history. We were getting richer by the second just by sitting there eating roasted lamb. But then, the check came. The waiter placed the little black leather folder in the center of the table. The conversation didn't stop, but it stuttered. I watched Steve's face as he picked it up to calculate the split. Just for a microsecond, a frame of video you would miss if you blinked, the mask slipped. He looked at the subtotal. He looked at the tax. He looked at the tip calculation. And I saw the wince. It wasn't a "I can't afford this" wince. Steve is a partner at his firm. He can afford the dinner. It was a "this makes no sense" wince. It was a flicker of genuine confusion. He was looking at a number that 5 years ago would have been a car payment. Now it was a casual Tuesday dinner. He paid it, of course. He smiled. He signed the receipt with a flourish. But the electricity in the booth had died. Driving home that night, I couldn't shake that moment. I kept replaying the two images in my head. Image 1, Steve's phone screen showing a graph going vertical. Wealth, abundance, records. Image 2, Steve's face looking at the bill. Confusion, tightness, a subtle sense of being robbed. That right there is the dissonance. That is the splinter in your mind that won't go away. We are living in a split-screen reality. On screen 1 we have the scoreboard. The stock market is booming. Housing is up. GDP is up. Net worth is at record highs. On this screen we are living in a golden age. The numbers say we are winning. On screen 2 we have the reality. You are standing in the grocery aisle looking at a bottle of olive oil that costs $28. You are looking at your car insurance renewal, which is up 40% for no reason. You are looking at your record high salary and realizing it evaporates by the 20th of the month. On this screen we are falling behind. How can both be true? How can we be richer than ever and poorer than ever at the exact same second? How can the chart say boom while the wallet says bust? Usually when this happens we have a default reaction. We blame ourselves. We think, maybe I'm just bad with money. We think, maybe I'm ungrateful. Look at the chart. The chart says I'm winning. Why do I feel like I'm losing? We gaslight ourselves into believing screen 1 because screen 2 is too uncomfortable to face. But what if we aren't the problem? What if the dissonance isn't a glitch in our psychology? What if the scoreboard is answering a different question than the one we are asking? The numbers on Steve's phone were real. He really did make 22%. But the number on the receipt was real too. The mystery isn't about the score. The mystery is about the unit of measurement. We think we are scoring more points, but the truth might be, the points just got smaller. I need you to visualize something with me. We need to step away from finance for a moment. Finance carries too much baggage. We have too many emotions tied to words like dollars and yield. So let's talk about something tangible. Let's talk about carpentry. Imagine you are a master carpenter. You build high-end dining tables. You pride yourself on precision. You don't guess, you measure. Your most important tool is your tape measure. It's a steel tape measure. Yellow paint, black tick marks, rigid metal. An inch is an inch. A foot is a foot. A meter is a meter. These are constants. They are defined by physics. They don't have opinions. They don't care who the president is. They don't care about interest rates. A foot today is the same length as a foot in 1950. Now, I want you to imagine a scenario. Imagine that one night while you are sleeping, a prankster breaks into your workshop. He steals your steel tape measure, and he replaces it with one made of rubber. And not just any rubber. This is a special elastic rubber that reacts to heat. It's subtle. You wouldn't notice it just by holding it. But this rubber has a unique property. It shrinks just a tiny bit every single day. On Monday morning, you wake up. You go to the workshop. You grab the rubber tape measure, assuming it's the steel one. You measure a plank of mahogany. The ruler reads 10 feet. You write it down in your ledger. Inventory, 10 feet of mahogany. You go home. You sleep. On Tuesday night, the prankster sneaks in. He turns up the heat. The rubber contracts by 1%. The inch marks get closer together. Now think about the physics here. If the inch is smaller, it takes more inches to cover the same distance. So, on Wednesday morning, you measure the same plank of wood. Because the inches are smaller, the ruler reads a higher number. The ruler now reads 10 feet 1 inch. You stare at it. You blink. Honey, you scream. Come look. The wood is growing. My inventory is up. I'm creating value in my sleep. You feel a rush of excitement. You didn't do any work, but your assets are growing. On Thursday, the ruler shrinks again. You measure the plank. Now it reads 10 feet 2 inches. On Friday, it reads 11 feet. You are ecstatic. You call your investors. You update your balance sheet. My assets are up 10% this week. I am a genius carpenter. You feel rich. You feel validated. The numbers prove it. But then, on Saturday, you try to build a table. You sit down to do the work, and you realize something horrifying. The wood doesn't go any further than it did on Monday. It covers the same surface area. It holds the same number of plates. It seats the same number of people. The asset didn't change. The ruler changed. This sounds absurd, right? It sounds like a children's book. But this is exactly, mathematically, what is happening to the S&P 500. This is exactly what is happening to the Zillow estimate of your house. In the financial world, we don't have a meter. We don't have a constant physical object stored in a vault in Paris that defines length. We have the dollar. And we treat the dollar like it's a steel ruler. We operate on the assumption that $100 today captures the same amount of value, energy, and effort as $100 in 2019. But it doesn't. Over the last few years, the ruler has been shrinking. Not because anyone planned it, but because that's how the system behaves under pressure. They printed 40% of all dollars in existence in a 24-month window. They flooded the system with tick marks. So when you see the Dow Jones go from 30,000 to 40,000, when you see your house go from $400,000 to $600,000, you aren't necessarily seeing growth. You aren't necessarily seeing value creation. You are seeing the numeraire effect. That's the fancy academic term. I prefer the rubber ruler. You are measuring the same pile of bricks with a shrinking yardstick. Of course, the number is higher. It has to be higher. If the unit of measurement gets smaller, the measurement must expand. That's not economics. That's arithmetic. Now, I know what you're thinking. You're thinking, okay, but some of it is real, right? Companies are making money. Amazon is shipping packages. Nvidia is building chips. It's not all a trick. Fair point. So let's strip away the illusion. Let's look at the math without the rubber ruler. In finance, every price you see on a screen is a fraction. It is a ratio. Price equals numerator divided by denominator. The numerator is the asset, the share of apple, the barrel of oil, the house. The denominator is the currency, the dollar, the euro, the yen. When the chart goes up, when the price increases, it creates a blind spot. We instinctively assume the change happened in the numerator. We assume the asset got better. But mathematically, the price goes up just as fast if the denominator gets worse. So let's run an experiment. Let's measure the American stock market using a ruler that Jerome Powell cannot shrink. Let's find a steel ruler. What is the closest thing we have to a financial constant? Gold. Gold is boring. It's a rock. It doesn't pay dividends. It doesn't invent AI. It doesn't run ad campaigns. But it has one superpower: it cannot be printed. It requires energy to extract from the earth. The supply grows very, very slowly. It is a stable denominator. So, let's take the S&P 500, the index of the greatest companies in America, and instead of pricing it in dollars, let's price it in gold. If you pull up that chart, it doesn't look like a rocket ship. It doesn't look like an exponential curve to heaven. Looks flat. It looks like a volatile, sideways churn. In fact, since the year 2000, the real value of the stock market, measured in gold, is down. We are technically still below the highs of the dot-com bubble in real purchasing power terms. Let that sink in for a minute. 25 years. A quarter of a century. In that time, we invented the iPhone. We invented cloud computing. We invented social media. We cracked the human genome. We built electric cars. We started the AI revolution. Trillions of dollars of purported value creation. Humanity has become exponentially more productive. And yet, if you measure the stock market in a hard currency, we haven't made a structural new high. The line is flat. Let's try another ruler. Maybe gold is too old-fashioned. Let's use M2 money supply. This is the total amount of cash and checking deposits in the system. It represents the pool of liquidity. If you divide the S&P 500 by M2, the line is almost perfectly horizontal. Do you understand what this implies? It implies that the growth you see on TV isn't growth in value. It is monetary absorption. The stock market acts like a sponge. New liquidity enters the market and the market absorbs it like a sponge. The sponge swells up. We look at the swollen sponge and say, wow, look how big the economy is. No, it's just wet. The companies didn't get 50% more valuable in real terms. The money became 50% more abundant. The table didn't grow. The ruler just shrank. This phenomenon creates a massive systemic optical illusion. Economists call it nominal confusion. It's a glitch in human psychology. We are wired to trust the number. Our brains are not evolved to calculate relative currency devaluation in real time. If I give you a $100 bill today and a $100 bill 10 years from now, your brain recognizes them as the same object. Even if the second bill buys half as much groceries, the system relies on this glitch. It exploits the difference between nominal, the number on the paper, and real, the purchasing power. Think about the rubber ruler again. If the ruler shrinks, every measurement you take looks bigger. This creates a sensation of forward motion. It triggers the dopamine receptors in your brain. I'm making money. I'm getting ahead. Look at my account balance. But in physical reality, you are standing still. This is why Steve at the dinner party cheered. He saw the nominal number, up 22%. He didn't calculate the real number, minus the debasement of the currency. The government loves nominal highs. Imagine if they told you the truth. Imagine if the president went on TV and said, "My fellow Americans, to manage our debts, the purchasing power of your savings will quietly decline over time." That speech wouldn't last 5 minutes. Not because it's wrong, but because no one wants to live inside that sentence. But if they say, "Good news, your house value went up 7% this year," you throw a party, you feel rich, you renovate the kitchen, you vote for the incumbent. The mathematical result is identical. In both cases, the currency lost value. But the framing makes one feel like theft and the other feel like a windfall. They have weaponized the measurement to keep the population docile. We are running on a treadmill. The screen on the treadmill says we are running fast. The numbers are blurring. 10 miles per hour, 12 miles per hour. But we aren't going anywhere. We are just measuring the same distance with smaller and smaller steps. Why does this work so well? Why do smart people, doctors, engineers, even hedge fund managers, fall for the rubber ruler? Why did everyone at that dinner party feel rich, even though the bill hurt them? Because of anchoring. We anchor our perception of value to the prices of our past. We have these reference prices burned into our hippocampus. We remember when a movie ticket was $5. We remember when a decent family house was $200,000. So when we see a house selling for $800,000, our brain instinctively translates that into 4 times the value. We think, wow, that must be a mansion. That must be luxury. But then you go to the open house, and it's a 3-bedroom ranch with a leaky roof and a bad foundation. It's the same house that cost $200,000 15 years ago. The house didn't improve. The bricks didn't turn into gold. The neighborhood didn't become paradise. The denominator collapsed against the house. But the dissonance creates a blind spot. We refuse to believe that the currency could break that badly. We refuse to believe the ruler could shrink that much. It feels unstable, feels scary. So we prefer the lie. We prefer to believe that real estate always goes up. It's a comforting narrative. It implies that time equals wealth. It implies that if you just sit there and hold an asset, you will get rich. But in a rubber ruler regime, time doesn't equal wealth. Time equals dilution. If you sit there and wait, the ruler shrinks around you. The number goes up, but the house stays the same size. And if you sell that house for a profit, what can you buy with the money? You can only buy another house that has also gone up by the same amount. You haven't gained purchasing power. You've just swapped one expensive box for another expensive box and paid taxes on the illusion of profit. This is the part where people usually expect something dramatic to happen. We've been trained that when something goes wrong in the economy, it's loud. Sirens, headlines, red arrows screaming downward, people panicking on trading floors. That's what failure is supposed to look like. But what if that expectation is the problem? What if nothing breaks? What if the numbers keep going up and the damage happens somewhere else? Think back to the ruler. Nothing snapped in half. There was no explosion. No moment where everyone stopped and stared. The ruler just shrank. Quietly, gradually, day after day. Every measurement still worked. Every calculation still looked correct. The math never failed. It was the reference that drifted. And that's what makes this so hard to see. Because when the unit changes slowly enough, everything feels normal. The market looks healthy. Your account balance grows. The headlines stay optimistic. But the distance between the numbers and real life starts to widen. You feel it when a salary raise doesn't change your lifestyle. You feel it when a great year in the market doesn't reduce anxiety. You feel it when milestones that used to mean security now just mean survival. Nothing collapsed. Nothing crashed. The system kept measuring itself, using a unit that no longer meant what it used to. So from the inside, it doesn't feel like disaster. It feels like confusion, like effort without progress, like motion without arrival, not falling apart, just drifting out of alignment. So let's go back to that booth at the steakhouse. Back to Steve. Back to the cheering. Back to the wince when the bill arrived. What do you do with that moment? You don't argue. You don't lecture. You don't ruin the dinner. You just notice it. You notice that the scoreboard and the lived experience are no longer speaking the same language. That the numbers aren't wrong. They're just answering a different question. At some point, you stop chasing the feeling that the chart is supposed to give you. You stop waiting for the number to make things feel lighter. Not because you've figured everything out. Not because you have a plan, but because you finally understand why it felt off. The market didn't surge. It didn't fail. The ruler changed. And once you see that, you don't look at prices the same way anymore. You don't see a number. You see a relationship. Not growth or decline. Just a ratio, trying to describe a world that quietly moved underneath it.